Hey, welcome everyone to today's episode of The Everyday Investor. Over the summer, I've been doing some planning work and refining my own strategy for 2024. There's my family and my personal life, there's my business world, and there's my investment world, and then there's even this podcast. I'll put it all through a purpose-based strategic process, something that I would do if I was sitting in front of one of my own financial advice clients. So I did all that process on myself. I forced myself to take my own medicine. I literally sat across the table from myself. I swapped places. I must say I'm a bit of a tricky client, but it put me in a much better space to see clearly the objectives that I want to reach this year, how I might do it, and the reasons why I might want to do it. It's an introspective process. I hate the idea of thinking about myself too much and spending too much time just thinking about stuff and not enough time doing, but it's important every now and then to stop and to strategize. So something that came out of my planning and strategy for 2024 involves expansion. So before we start on the main topic of today, I'm going to exploit the fact that I'm having about 30,000 individual one-way conversations a month through this podcast. And I want to put out a little bit of a help wanted ad for my business, if I may. For background, I own a financial advice business based in Auckland, New Zealand. I offer financial advice on an hourly basis, as well as the usual no-fee advice model that many other advisors will use when setting up and reviewing mortgages, insurances, and investments like KiwiSaver. Scaling up a business like mine, though, can be a little bit challenging, especially if you're doing it a little bit differently. And over the last couple of years, it's been really hard trying to get the right people on the team. So rather than go down the traditional way of recruiting people by placing job ads and commissions to recruitment people that I don't know, I'd love to ask you for some help, if you don't mind. This may be for you, or maybe it's for someone that you know. I'm looking for an administrator, a marketing person. I'm looking for another mortgage advisor and an insurance advisor. Ideally all with track records in new business and existing business, New Zealand-based experience of at least 2 years, level 5 qualifications as a minimum. Most importantly, someone with a bit of ambition to join me in taking things to the next level. Check out the link in the show notes just to have a conversation with me, and we'll see where it goes. Now, back to this episode. If you're aiming to get wealthy on your own, and if you're starting with nothing or not much, the great news is that if you're living in the right country, and New Zealand's one of them, free country, with the right mindset, you can actually achieve quite a lot. There's a lot that you can control in your world that will drive success. And even when the things are happening all around you that you can control, we can still adjust our response to those uncontrollables. So today we're talking about something that we definitely couldn't control recently. It was inflation. The inflation data, consumer confidence and business confidence, mainstream media, all that sort of stuff. It doesn't come close, in my view, to the value of everyday conversations with everyday investors that I get to have one-on-one, and especially when I get survey results. And back in October of last year, I put out a survey to find out how you were all coping with inflation. The number of you who completed it was amazing, and it kept on coming in, so I just let it roll. And even though I planned on doing this episode a couple months ago, I just let it go and kept on waiting for people to stop completing the survey. So apologies for taking so long, but today I'm going to be sharing the results of that. Prices rose, according to official data, about 22.8% since March of 2020. Chances are inflation may have affected you. Thankfully, there may be some light at the end of the tunnel that could start to materialize in 2024. But before we get there, the great thing about high inflation is that it forced us to take a closer look at how the financial system actually works. You don't need to do this, of course, but my belief is that it's made me personally a lot more confident in how I invest now that I know a little bit more about how things actually work, and occasionally not work, in the system that my dollars are at work in. So my hope is that in sharing some of the views that you may hold, and by having a discussion along the way, just to simply reflect on the season that has been, we might be able to lock in some of the understandings of that season, if that makes sense. So consider this episode just a really basic one, and it's just me, and I'll keep it pretty straightforward. Let's make a start. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. All right, so today you'll know a little bit more about where you sit relative to many of the others that tune in each week also. Each of the questions I asked in this survey on inflation, launched in October last year, are included in today's episode. Not necessarily in the exact order, but more or less in the same order. So to start with, though, I'll cover the basic questions just so that you can get a feel for the type of people who completed the survey. The first question was, can you tell me your gender? Well, 100% of you were more than happy to answer this based on only two choices. 59.21% of you are male, 40.79% of you are female, which is, good to know. Interestingly, if you subscribe to the YouTube version of the podcast, there's actually a 94% chance that you're a male. So take this as you like, but I'd assume, this means that I have a face for audio. There you go. Can you tell me your age was the next question. 97.37% of you are within the range of 25 to 64 years old, but 72.37%, the majority of you, 3/4-ish, are between 35 and 54. Now, between the ages of 35 and 54, more or less, you're probably earning the most that you'll ever make, and the pace at which your income is growing, adjusted for inflation, is likely the fastest that it will ever be as well. You're making the hard choices between lifestyle optimization, like travel, renovations, and having kids, and investing to fund your future self specifically. This is your prime time. Here you are building up. You're accumulating first, and then you're harvesting later on. You're expanding, and then you're consolidating. You're leveraging up, and then you're winding it down. I'm in this zone. Pretty much all the clients that I work with are in this zone, and even a lot of the guests that I talk with on this podcast are in this zone also. Kids, mortgages, businesses, your net worth. You've got skin in the game in this age range in particular. Next question, what's your combined household income? Now, income is the numerical evidence that you've put in effort somewhere along the line. I think it's awesome to see people earning a lot of income, and it should be celebrated. If you're earning good money either directly or through someone else, well done, full respect. Almost 2/3 of households listening have more than $200,000 a year worth of income coming in. 29.19%, almost 1/3 of people listening, live in a household earning more than $300,000 per year. Now, just to pause and translate this into the investment realm a little bit, when you invest, one of the things that you can pursue is investment income, or a regular stream of consistent payments either from dividends, which is the share of company profits, or interest, which is the income from money that you lend out either to a bank or through bonds. When we invest, one of the fine-tuned adjustments we can make is to adjust the blend between income and growth assets that we target. Income for the slow, steady, yet predictable pathway, and growth for the promise of unlimited capital gains in the future, often only realized when you sell or convert the investment back into cash. Income and growth, yield and gains. Investors in the building up phase, between the ages of 35 and 54 especially, may often pursue the growth first, then harvest later strategy. Growth, then yield. Now, this involves owning investments that have the opportunity to grow in value well during the period of time where there is a strong household income present. Closer to when the flow of household income declines or starts to decline, there's then a transition away from growth assets into more of the income style assets. A growth first, harvest later strategy works well in a household with strong income, but ironically, it's often those households that appreciate just how dependent they are on their income, which then attracts them to pursue a yield or income strategy first instead of growth investing. Now, I'm not suggesting that this is unwise necessarily, because everybody's situation is unique, and it's completely understandable to attempt to replace your day job income with investment income instead, but in some cases, it's the least efficient strategy to accumulate and build up yield assets exclusively. Now, I better move on to the next question before I get distracted on that one. Has your spending habits changed in the past year? And if so, how much has inflation affected your lifestyle in the past 24 months? So the results were kind of surprising, I think. 72.37% of you said yes, you have changed your spending habits in the last year. And 84% of you said inflation has impacted your lifestyle, with 31% saying it's impacted your lifestyle severely. So what does this mean? Well, let's get to the foundations here. And by the way, skip ahead about 7 minutes if you like. But for those who want to know more about why we are in this situation with high inflation, I'll try to break it down as simply as I can. And I'm going to start with several definitions of inflation that are definitely all very imperfect, by the way. Firstly, inflation is the general increase in the prices of goods and services over time. Next, inflation is when too much money chases too few goods and services. Then, inflation is when our purchasing power declines, or we can buy less with the same amount of money. My personal favorite is this one, though. Inflation is a hidden tax facilitated through our financial system under the guidance of a central bank who has a monopoly on the money that we're forced to use. Slightly more controversial. Now, in New Zealand, the average inflation rate has been around 6% for the past 3 years. 6%. That's higher than the target range of 1 to 3% that the Reserve Bank of New Zealand, RBNZ, aims for. The RBNZ is the central bank that influences the creation of new currency within our economy and the price of it, or the interest rates. The Consumer Price Index, or CPI, is used to track inflation, which is then what helps the RBNZ set the interest rate. The CPI is based on a basket of goods, a hypothetical collection of goods and services that represent the average consumption of a typical household. The CPI is an imperfect indicator, though. It doesn't capture the fact that your mortgage payments may have increased by over $1,000 a month last year, for example. It also assumes that people will substitute cheaper goods for more expensive ones over time, such as sausages for steak. And I guess you keep on going with that, and eventually we're all eating crickets, right? But still, the CPI, or the CPI, as some would call it, is important because the central bank, or the Reserve Bank of New Zealand, uses it to decide its monetary policy, or the way in which they go about tinkering with their settings periodically. The main tool is the official cash rate, or the OCR. This is currently 5.5% at the time of recording here in January 2024. The OCR affects the interest rates that banks charge for loans and pay for deposits. The next adjustment or review of the OCR is due on February 28th, 2024. Even if they don't make a change to this rate, what they say about where it will go in the future is often what investors will look at more for clues as to whether or not the economy is going to have a headwind or a tailwind. The philosophy behind monetary policy is simple, yet like with anything with economics, including this explanation of it, it's imperfect. If the Reserve Bank of New Zealand wants to stimulate the economy, though, it lowers the OCR, drops interest rates. This makes borrowing cheaper and savings less attractive. This should incentivize spending and maybe even incentivize investment too, because the cost of borrowing for investment declines. This can have the effect of boosting economic activity, which ultimately creates jobs, lifts the rate of employment. On the other hand, if the economy overheats, with inflation as the indicator of that overheatingness, then it will raise the OCR, it'll raise interest rates to disincentivize borrowing and incentivize saving. In this way, they are sucking money out of circulation. So think of it as blood pressure. They're injecting more blood into the system or less blood out of the system to decrease activity. And the idea here is that they're trying to slow down or increase the speed of economic activity, which will either reduce the likelihood of a recession or induce a recession. And in the process, they are either creating or slowing down the rate of inflation, all to reach that magical Goldilocks zone of 1 to 3%. It's simple when looking at it in theory, but in practice, it's hard for central planners to influence what's supposed to be a free market, especially without making it worse. And here's the problem. There's constantly trade-offs between inflation and growth. New Zealand once led the way through Arthur Grimes, who helped the RBNZ introduce inflation targeting in about 30 years ago. And we talked about this a little bit with a discussion that we had with Michael Riddell about 3 months ago or so on the podcast. The inflation of the 80s came under control as a result of this inflation targeting policy that they introduced, and central banks around the world started to follow suit. We led the way. The public had confidence that prices would be stable, and this led to a period of economic growth. But things changed after the global financial crisis of 2008, and especially after March 2020. The RBNZ, along with other central banks, took drastic measures to support the economy and prevent a depression. They slashed the OCR to 0.25%, the lowest level ever. They relaxed the rules that limited the amount of money that banks could lend to home buyers and property investors. They made it easier for banks to access cheap funding, and they started buying government bonds like there was no tomorrow and other assets from the market, injecting billions of dollars into the system. I've been critical of the RBNZ's policy for a while. I personally feel they should have reversed course way sooner. They waited far too long to acknowledge the inflation problem, and they were far too slow in raising the OCR. They've wasted over $10 billion of taxpayers' money on quantitative easing, which hasn't in fact boosted the productive sectors of the economy. The only thing it did was inflate the property market and provide fuel for the socialist government of the time to target property owners. The RBNZ failed to maintain price stability, which was their core mandate. They had one job to do. But enough of my rant. Let's get back to the survey results. How does that sound? How does inflation affect you and your spending habits? In a rational household, higher interest rates don't affect the demand for needs. They just reduce the demand for wants, or this is how it should work. This is often where our spending habits change the most, in our discretionary spending. Inflation affects some people differently than others. Now, I'm particularly concerned about the 31% of you who said that inflation has impacted your lifestyle severely. These are the people likely in growth mode, using debt to get ahead. They're not expecting or they're not dependent on handouts. They're nice contributors to society, right? They're happy to take risk. They're happy to work hard. But they are the ones that get hammered the most. These are the people who are most likely to suffer in silence, to feel isolated, and potentially to struggle with mental health as well. Worst case scenario, these are the people who may be tempted to live beyond their means too. They'll drain their savings in the process. They'll rack up credit card debt in the process, and they might even cash in their long-term investments just to live the lifestyle they had 3 years ago. Moving on, have you experienced higher mortgage payments for over a year? And if so, has this cut into your discretionary spending? Just over 55% say yes, they have had higher mortgage payments for over 1 year now. And just over 70% say that this was the cause of them not spending so much. Throughout most of 2023, those who had to refix their mortgages during this period of time, they were nailed with higher interest rates. It wasn't uncommon for me, for example, to see people who were coming off of interest rates in the low 2s, refixing for interest rates closer to 6%. A $1 million mortgage taken out in 2020, fixed for 2.5% as an example, would have cost $911 per week. 2 years later, at 6%, this would become $1,412 per week. Inflation may have only been 6%, according to the CPI, but mortgage payments increased in this situation by a whopping 55%. Because mortgage payments aren't directly captured by the official inflation data, remember, those with mortgages carried a disproportionate, underreported burden. Thankfully, though, there may be some light at the end of the tunnel for 2024. As long as inflation is heading in the right direction, my view is that rates will ease sooner and by a larger degree than even I thought just a few weeks back. So, yeah, I'm feeling much better in 2024. Moving on to the next question. Did your income increase in the past 24 months? And do you actively track your spending and maintain a budget? 69.74% of people had an increase in income. That's awesome. For perspective, an income of around $100,000 per annum in 2020 would have to be around $119,000 per annum to maintain the same purchasing power in 2023. Those paying attention may want to research where that purchasing power actually went. But if your income increased by 6% each year over the last 3 years, and you bought the same goods as the inflation index, you more or less kept your footing. If you had a mortgage, it was harder. Hopefully, though, you've managed to hang in there so far. And the good news is, if your mortgage balance stays the same, but your income rises because of a pay rise, when your income grows but your debt doesn't, you're winning eventually. Why? Because assuming interest rates are constant in the long run, your income eventually adjusts for inflation, but your mortgage doesn't. Inflation still hurts, though, especially in the short to medium term. Inflation makes us work harder and longer hours just to stay still. Inflation is bad, right? I think I've made that abundantly clear. But remember the days when only one parent went to work? Well, why was it that we were encouraged to send both parents off to work? Was it really about equal rights? I'm sure that was a good thing, but it was also kind of, well, they had to, right? Investing isn't just for the already wealthy then. It's essential for the everyday person to fight a system that robs us of our wealth over time. If we're already at full capacity in terms of how many hours we can trade for income, what are our options? We have to leverage with the leftovers, and that's what investing is. Before you invest seriously, though, and especially if you're presently trying to find a new state of equilibrium within your household budget, which is under stress because of inflation, you need to consider your finance habits. Now, almost 75% of respondents track or budget their spending. Again, this is amazing. This is actually really good. Way better than I thought. Those with low incomes need to budget because there's no room for error. But as we've seen in the other parts of the survey, a lot of people are actually earning really good money. And what I've normally seen is that those people with higher incomes often don't budget because they actually kind of feel secure. They know they have more than enough. And in a period of inflation, I think this is a real weakness. The high earners that I talk to often have anxiety about their spending, and especially recently. And I think it's made worse by the fact that an abundance mindset, which is often what those who earn good money have, well, it's great for wealth creation, but it actually clashes with budgeting, which is, rightly or wrongly, a restrictive feeling for many people. Now, I've experienced this myself, and you actually need to go through a process where you look at two things at the same time. You need a special type of cognitive dissonance to think abundantly yet frugally at the same time. Strong personal finance can be liberating, though. Spending with purpose and mission is awesome. It's way better than the opposite. There's no regrets this way. Not convinced? Well, try something. Forget the budget if that scares you or if you don't like that word, which I totally understand. But just start to become more aware of where your money goes. Check out some spending tracking tools out there. One of the tools that I use to track our spending in our household is our bank's online platform. They give you the option to track your spending for free. So you can code up your expenses with your food, entertainment, clothing, school fees, mortgages, whatever it is. Code them all up from your credit cards and all the accounts where the money is going out from. And then you can just track your spending. Yeah, see where it goes. That's the first step in controlling it. Seeing reality clearly, that's half the battle, right? If you want to go even further, check out New Wealth Foundations, the online course that we built last year, where we cover the basics that you need to know for building serious wealth. Honestly, if you get the foundations right, so much easier building something that can be maintained on top of it. The link is in the show notes. Moving on to the next question. Are you considering moving overseas in the next 2 years? Well, just over 12% of you say yes in the next 2 years. We're out of here. But 88% of you say no. And hey, well done. Thanks for saying. Seriously though, New Zealand is one of the best places to live in the world. It's not the easiest place to live, I get it, but I still think it's one of the best places to live in the world, and especially in the new world that we're heading into, it feels a lot safer, let's put it that way. And as far as an investment thesis as to why own property in New Zealand, there's a lot of people in the world with a lot of money, and if they're free to move and the world gets a lot scarier, where would they want to move, which is the furthest distance away from where the action is, and the bad kind of action I'm talking about, right? And there's not a lot of land here. Surely, from a scarcity point of view, higher demand meets limited supply. That only results in higher prices. But again, that's another topic. Now, next question is super interesting, and I wonder if I asked it today, even just 3 months later after the survey first started, the answers would probably be quite different. Do you think inflation will drop below 3% in the next year? What about the next 2 years? And when are you expecting interest rates will drop? Now, about 46% of you believe that it will take longer than 2 years for inflation to fall below 3%, which you'll recall is the upper limit to the Reserve Bank of New Zealand's target. Now, about 30% of people believe it will take longer than 2 years for interest rates to fall. So some believe it's higher for longer in terms of interest rates, and others believe it's lower and sooner. Now, I admit I changed my mind a lot on this topic in 2023, which meant I was genuinely unsure about interest rates and therefore the direction that markets would head. The podcast I talked to with Michael Every made me think perhaps that lower interest rates were actually gone forever. The 40-year trend of falling interest rates was over. Why? Well, here's my take on the conversation I had with him. The reason why interest rates were likely going to increase and stay higher for longer was due to the nasty 3-letter word we call war, because it's yet another reason why government may need to get larger in the pursuit of an enemy that only they can fight on our behalf. How best can we change the focus of where our output goes in a country with consumerism as the main driver to a country that needs to be more geared for a war machine? Well, higher interest rates for the commoner and lower rates for the central planners. That's the idea. This shift, though, would represent the end of the current U.S.-centric global order, complete with the U.S. dollar as the world's reserve currency. Again, this is my take from that conversation. And just like any theory about the future, it's not hard to make a call about where things will go and to provide the justification for that thesis, but it's quite another thing to pick the timing. And I understand the basis behind the death of lower for longer. And in a sense, I actually do believe that there's some truth in this. The timing is the issue. This could all happen this decade, or it might take a generation for that to play out. And why is the timing so relevant? Because a reversal in a trend of falling interest rates over 40 years would affect everything, including property prices. So if you're an avid property investor and you're just starting out to accumulate your portfolio and you're thinking long-term what your values will be in the future, just remember the last 40 years we've seen falling interest rates. Interest rates and property prices are negatively correlated. So if we have a reversal, what does that do for property prices? Well, it's not good. That's why that type of discussion and that type of thought can be so disturbing. Now, I also talked with author Jeff Booth about how technology should actually make everything cheaper over time. Imagine AI mixed with robotics and even a sound money system like Bitcoin thrown in there. Well, we can all live in abundance. Deflation would actually be the norm, not inflation. And our money would actually gain in value over time, which means that we'd need to work less just by default. We'd never need to strive for anything anymore, and we'd always get more the longer we wait. We could defer consumption and be better off for it. Now, much like speed and direction, or velocity, tells us exactly how long it will take to get somewhere, predicting the event is useless without a time frame. Technology operates on an exponential curve, though. So in one world, there's increasing centralization and global conflict, complete with high interest rates. And in another world, we have decentralized power, sound money, and deflation. I know which future I'd pursue. So interest rates may be higher for longer, or we may transition into an age of abundance. In the meantime, though, lower interest rates for 2024 is likely what we're going to get. The U.S. Fed indicated this late last year quite explicitly, and the Reserve Bank of New Zealand will likely follow suit for reasons which will be whatever they will be, but they will be the same, no doubt. We'll know for sure in a couple of weeks. Even the expectation, though, of falling interest rates started to send tech stocks upwards last year, and then Bitcoin too. And I think of this like the ponds that I used to skate on when I was a kid in North America. The ice thawed in the springtime from the center of the pond, and then it moved towards the edges as the temperature heated up. And in the same way, optimistic sentiment often affects riskier assets first. That's how you know things are about to change. Now, getting back to the question though, 46% of people believe that it will take longer than 2 years for inflation to fall below 3%. And about 30% of people believe it will take longer than 2 years for interest rates to fall. So again, if this survey was done today, I bet it would look different. But I want to point out something that isn't immediately obvious. Why aren't we more angry about the rate of inflation that we've seen over the past few years? An extreme libertarian, for example, may suggest that taxation is theft, just in plain sight. If that's true, then inflation is more of a covert type of theft. I'm not sure you have to be an extremist to expect more accountability from governments and central banks, but I think we should be expecting more accountability from governments and central banks, perhaps even an apology. Like, come on. Even by their own defined mandate to maintain price stability, the Reserve Bank of New Zealand has clearly failed, and it's caused an immense amount of economic and societal problems. We're not encouraged to think critically about this, though, are we? Mainstream media doesn't really pick up on this. Is it too complicated? I don't know. And I love paying taxes, don't get me wrong, but I do expect value for any service that I pay for, and I think you should too, right? And on the other hand, if we target inflation above 0%, there's a whole bunch of reasons why we're told that the inflation rate should be positive. But if we're doing that, it actually means that whatever we own today is worth less by default in the future. And what do we get in exchange for the wealth that we're losing this way over time? That's just something to think about, right? Now, let me try and bring this one in for a landing. I'm feeling more confident by the week that the period of high inflation that we've been in, and therefore the period of high interest rates, will start to come to an end in 2024. And along with it, I believe the interest rates will potentially decrease at a rate which is faster than what many economists are predicting. Now, as painful as it's been for many people, including myself, being an avid consumer of mortgage debt personally, there's going to be some light at the end of the tunnel, and we'll come out better off in the long term as investors, especially if we can hang on to our assets in the interim. If anything needs to be cut back, it should just be our discretionary spending so that we can hang in there. Because the great thing about high inflation is that if you're using it to your advantages and you hold multiple assets over time and you're using debt as leverage to build, it actually gets you further faster. But it's also highlighted the fact that for a larger group of people anyway, there is a problem that exists within our financial system. It's actually hardwired into the system. The mandate for price stability that includes an objective to maintain a positive rate of inflation is an explicit game plan to steal wealth. Now, it might not be out of malice, it's just out of design though. The first step in improving anything that's munted like this is first admitting that there is a problem with it. Governments and central banks will be quick, along with most media, to point at the cause of inflation being supply chain disruptions or greedy corporates price gouging. But those who control the money really do control the world. So instead of thinking right or left in your politics and blaming each other, I think it would be a little bit more wise to start thinking up and down more when it comes to the financial system. Understanding that system that your dollars are at work in is just part of becoming a better informed investor. Taking risk with your investments to accrue more of a currency which loses value from bureaucratic design doesn't make sense. It's just not a good game plan. And with that, a timely reminder here, the views expressed today aren't perfect, and of course, they're just opinion. But everyone else's is just opinion as well, and they're equally as informed in my view. So thanks again, though, for those of you who contributed towards the survey results and for listening in to this episode today. We'll catch you on the next episode. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.